Apple has announced a significant $100 billion investment in U.S. manufacturing, aligning with former President Donald Trump's America First agenda. This new commitment builds upon Apple's previous $500 billion investment pledge, made earlier this year, bringing the total planned investment to $600 billion over the next 4 years. The move is strategically timed as the Trump administration intensifies its tariff policies, threatening a 25% tariff on goods from countries like China and India, where most iPhones are currently manufactured. By increasing its domestic production, Apple aims to mitigate the financial impact of these tariffs, which cost the company $800 million in the second quarter of 2025 alone. The investment includes the creation of an American Manufacturing Program, AMP, to bring more of Apple's supply chain to the U.S., focusing on producing critical components domestically. This initiative is expected to create thousands of high-paying jobs, particularly in states like Michigan, Texas, and California. Additionally, Apple's partnership with Taiwan Semiconductor Manufacturing Co., TSMC, will expand with a multi-billion-dollar commitment to produce advanced silicon at TSMC's Arizona facility. The market responded positively to the announcement, with Apple's stock rising 2.8% in pre-market trading, reflecting investor optimism about the company's ability to navigate tariff risks. However, some analysts remain skeptical about the feasibility of fully deploying the $600 billion commitment, given the complexity of Apple's global supply chain.
Vanguard, one of the world's largest investment management companies, has advised investors to adopt a more conservative asset allocation strategy, recommending a 70% investment in bonds and 30% in stocks for the next decade. This suggestion diverges from the traditional 60-40 stock-to-bond ratio, which is commonly used for balanced portfolios. The recommendation comes amid high stock valuations and a prolonged bull market, which have led to elevated equity prices. According to Vanguard's projections, U.S. equities are expected to yield annual returns of 3.3% to 5.3%, while bonds could deliver slightly higher returns of 4% to 5% over the same period. The rationale behind Vanguard's strategy is rooted in current market conditions, where stock valuations, as measured by the Shiller-Cape ratio, are at levels comparable to historical peaks that preceded significant market downturns. Furthermore, the equity risk premium, which represents the additional return investors expect from stocks over risk-free assets like bonds, is currently low. This makes bonds more attractive, especially given the current yield of 4.2% on 10-year Treasury notes, which offers a robust, risk-free return. Vanguard's model, however, is not a blanket recommendation and should be considered alongside individual investor goals, risk tolerance, and tax implications. While the firm expects stocks to outperform over a longer timeline, such as 30 years, their current forecast suggests a cautious approach for the coming decade.
The financial landscape is currently witnessing significant legal challenges against former President Donald Trump's imposition of tariffs, which critics argue exceed his constitutional authority. The U.S. Court of Appeals for the Federal Circuit is being urged to declare these tariffs illegal, as they have allegedly caused substantial harm to American businesses and the broader economy. Key figures, such as economist Paul Krugman, highlight that Trump's use of executive orders to impose tariffs bypasses the legislative process, raising concerns about the overreach of presidential powers. The International Emergency Economic Powers Act, IEEPA, of 1977, which Trump cites to justify his actions, does not explicitly grant tariff authority, leading to skepticism from federal judges about the legality of these measures. The implications of this legal battle are profound for both domestic and international markets. Trump's tariffs, including a recent 25% duty on India for purchasing Russian oil, have rattled global trade relations and raised concerns about potential economic consequences. The ongoing litigation, which could eventually reach the Supreme Court, challenges the boundaries of presidential authority in economic policy. This situation presents a strategic dilemma for countries like India, which must navigate these tariffs while safeguarding their economic interests. As the legal proceedings unfold, the outcome could redefine the balance of power between the executive branch and Congress, influencing future trade policies and international relations.
Mastercard's latest white paper projects that Africa's artificial intelligence AI market is set to expand significantly, reaching $16.5 billion by 2030, up from $4.5 billion in 2025. The report, Harnessing the Transformative Power of AI in Africa, explores the continent's readiness and potential for responsible AI adoption across key industries such as agriculture, healthcare, education, energy, and finance. Mastercard emphasizes the importance of multi-stakeholder collaboration and investment to unlock AI's full potential, highlighting the continent's mobile-first infrastructure and entrepreneurial spirit as unique advantages. The white paper underscores the transformative potential of AI in job creation, with an estimated 230 million digital jobs by 2030, and in enhancing access to formal finance through AI-driven credit scoring and fraud prevention. It also addresses the challenges of data fragmentation and regulatory inconsistency, which could impede progress. Key developments in countries like South Africa, Kenya, Nigeria, and Morocco showcase the regional momentum, with strategic national plans and investments fostering AI ecosystems. Mastercard advocates for responsible AI that builds trust and drives inclusive growth, positioning Africa as a future leader in AI innovation.
Tata Consultancy Services, TCS, India's largest IT services firm, has announced a strategic move to issue salary hikes for 80% of its workforce, specifically targeting junior and mid-level employees. This decision, effective September 1, 2025, comes amidst plans to lay off approximately 12,000 employees this year. The layoffs, representing about 2% of TCS's global workforce, are part of the company's broader initiative to become a future-ready organization. This includes a focus on technology investments, AI deployment, market expansion, and workforce realignment. The dual approach of wage hikes and layoffs reflects TCS's strategy to reward and retain talent while simultaneously streamlining operations to adapt to evolving market conditions. The IT industry is currently grappling with macroeconomic uncertainties, geopolitical tensions, and the disruptive impact of AI, which have collectively dampened global tech demand. TCS's actions are indicative of a potential shift within the IT sector. As companies reassess their operational models to navigate these challenges, the company's focus on reskilling and redeployment underscores its commitment to leveraging new technologies and optimizing workforce capabilities in a rapidly changing business environment.
Former President Donald Trump is set to meet with advisors regarding an unexpected vacancy on the Federal Reserve Board of Governors, following the announcement that current Fed Governor Adriana Kugler will step down at the end of the week. This development presents Trump with an opportunity to appoint a new board member who aligns with his preference for immediate interest rate cuts, a stance he has been vocal about in his criticism of the Fed's current policies. The vacancy arises ahead of the planned expiration of Kugler's term in January, prompting Trump to consider whether to appoint a short-term replacement or a candidate for a full term. The decision on Kugler's replacement comes as Trump also contemplates his choice for the next Fed chair, with current chair Jerome Powell's term ending in May. Among the potential candidates for the chairmanship are Kevin Hassett, director of the White House National Economic Council, and former Fed Governor Kevin Warsh. While Trump has narrowed his list of candidates, the selection process remains in its early stages, with an official announcement expected by the end of the year. The strategic decision on whether to appoint a temporary replacement for Kugler could allow Trump to reserve the seat for his eventual chair nominee, given that the Fed chair must be a member of the Board of Governors.
DISA Technologies Inc. has successfully closed a $30 million Series A2 financing round, led by Evoke Innovations and Constellation Technology Ventures, CTV, to advance its high-pressure slurry ablation, HPSA technology. This funding round, which was oversubscribed, includes $23 million in primary funding and $7 million in secondary funding to provide liquidity for early investors. DISA's HPSA technology is designed to enhance mineral recovery and facilitate uranium remediation, offering a cleaner and more efficient solution for mineral processing and environmental cleanup. The investment will enable DISA to accelerate the commercial deployment of its technology, which has significant implications for mining operators and environmental remediation stakeholders. particularly in the context of abandoned uranium mine waste cleanup. The strategic involvement of CTV, the venture arm of Constellation, underscores the importance of DISA's work in uranium remediation, especially following a successful EPA treatability study and a subsequent agreement with the Navajo Nation EPA for a commercial-scale demonstration project. The company's efforts align with broader national goals of enhancing energy resilience and sustainability. DISA's application for an NRC service provider's license is under technical review, further positioning it as a leader in the remediation of abandoned uranium mines. The backing from notable investors such as Valor Equity Partners, Veriten, and Halliburton Labs further strengthens DISA's capabilities to expand its operations and enhance its technological offerings, promising significant advancements in both economic and environmental sectors.
Upstart Holdings, Inc., UPST, experienced a significant decline in its stock price following its second quarter earnings report, despite surpassing earnings expectations. The AI-driven lending platform CEO, Dave Girouard, addressed the market's reaction and provided insights into the company's future outlook and advancements in artificial intelligence technology. The decline in stock price suggests investor concerns may extend beyond short-term earnings, potentially focusing on broader market conditions or future growth prospects. The earnings report highlighted Upstart's continued integration of AI to enhance its lending algorithms, aiming to improve loan approval rates and reduce default risks. Despite these advancements, the market's reaction indicates potential skepticism about the company's ability to sustain growth amid a competitive fintech landscape and evolving regulatory environment. This development could impact investor sentiment and influence Upstart's strategic initiatives moving forward.
Rocket Lab Corporation, RKLB, is set to release its second quarter financial results, with analysts forecasting a revenue increase to $134.53 million, a significant rise from $106.25 million in the same period last year. This would mark a new quarterly revenue record for the company, surpassing the previous high of $132.39 million. Despite this positive revenue growth, the company is expected to report a loss of 11 cents per share, a slight increase from an 8-cent loss per share in the previous year. Rocket Lab has a history of surpassing analyst estimates, having beaten revenue expectations in 4 consecutive quarters and earnings estimates in 5 of the last 10 quarters. The company's stock recently reached all-time highs, driven by successful rocket launches and promising future projects, including the anticipated debut of its medium-lift, reusable neutron rocket in the latter half of 2025. Analysts are keeping a close eye on these developments, with some expressing concerns over the stock's valuation and execution risks. Stifel analyst Eric Rasmussen maintains a buy rating on the stock, raising the price target to $55, while Craig-Hallum analysts have initiated coverage with a hold rating, citing high expectations and potential pressure from any setbacks. Rocket Lab's strategic moves, such as the acquisition of optical systems producer Geost and potential contract wins from government initiatives like the Golden Dome missile defense system, are also key areas of interest for investors.
Core financial event. The emergence of Power Trades, an AI-based trading app, is gaining traction among Canadian retail investors for its balance of speed, security, and real-time market insights. This development is highlighted in the 2025 Canada Trading App Report, which underscores the app's unique proposition in the fintech space. Key entities, Power Trades, Canadian retail investors, and the broader fintech market. Context and impact. In a landscape increasingly wary of data breaches and bot-driven scams, Power Trades differentiates itself with its AI-driven insights and robust security measures. The app's machine learning algorithms provide high-probability trade signals, enabling users to make informed decisions in volatile markets. The focus on security, including bank-grade encryption and two-factor authentication, aligns with Canadian regulatory standards, enhancing the platform's credibility. This combination of technology and trust is attracting both novice and experienced traders, potentially influencing market strategies and investor behavior in Canada. As the app gains popularity, it could prompt competitors to enhance their offerings, further driving innovation in the fintech sector.